Welcome to Talk Tickers, your go-to for breaking down the earnings calls that matter. Today, we're diving into Movado Group's second quarter results for fiscal 26, which dropped on August 28th. And let me tell you, this one was a real head-scratcher, leaving the market with a fascinating puzzle to solve. So let's get right to it. Here's the central mystery we're unpacking today. How on earth does a stock rally, and rally hard, after posting a pretty significant miss on its earnings? It just doesn't seem to add up, right? Well, that's exactly what happened with Movado, and we're going to figure out why. All right, so here's piece number one of the puzzle, the big, ugly number. Movado came in with an adjusted earnings per share of just 23 cents. The problem? Wall Street was looking for 31 cents. That is a miss of nearly 26%. You know, the kind of number that usually sends a stock straight into a nosedive. But it didn't. Not even close. In fact, it did the complete opposite. By the time the closing bell rang, Movado's stock was actually up over 6%. So you've got this huge contradiction. A big miss on the bottom line, but a solid win for shareholders. Let's dig in and see what was really going on. To really understand the market's thinking here, we've got to look at how the trading day actually unfolded. The price action tells a story of, some initial doubt, followed by a huge wave of confidence. Yeah, the stock's journey through the day says it all. Right before the call, shares were sitting around 1681. Then at the open, they dipped a little bit to 1675. That's that classic knee-jerk reaction to the headline earnings miss. But as investors started digging into the actual details of the report, a totally different story started to emerge, and the stock just began this steady climb, closing way up at 1784. And listen, this wasn't just a quiet drift upward on low volume. No way. Trading for the day was about 43% higher than the 3-month average. What that tells us is that this rally was backed by some real conviction. There was serious money and serious interest behind this move. The market wasn't just ignoring the miss, it was actively buying into a completely different narrative. So the big question is, where did all that confidence come from? Well, the first clues are buried right there in the financial report itself, which honestly was a classic mixed bag of good news and bad news. This right here perfectly captures the report's split personality. On one hand, you have that ugly earnings miss we talked about. But on the other hand, the top line, the revenue, actually beat expectations by over 3%. It came in at almost $162 million. Now, for investors, a revenue beat is a huge positive sign. It signals that customer demand is actually healthier than people thought. But then, to throw another wrench in the works, management went ahead and completely pulled its financial guidance for the rest of the year. Now, this is usually a massive red flag. It suggests that the company has no idea what's coming, that there's just deep uncertainty ahead. So let's recap. A revenue beat, an earnings miss, and now, no guidance. The plot thickens. When the future gets cloudy, investors look for one thing: stability. And Movado's balance sheet is an absolute fortress. We're talking over $180 million in cash, zero debt, a commitment to paying their quarterly dividend, and an active share buyback program. This is what gave investors confidence. It shows the company has immense financial flexibility to weather pretty much any storm. And speaking of storms, Movado is sailing directly into a massive one. And this external shock, it provides the critical context for everything else. It's the main reason management pulled their guidance in the first place. 39%. Just let that number sink in for a second. This single number is the biggest headwind facing not just Movado, but the entire Swiss watch industry right now. It's a massive, newly imposed tariff from the US. So this tariff, which kicked in just a few weeks before the earnings call, is basically a 39% tax on all goods coming in from Switzerland. For a company like Movado, which relies so heavily on Swiss-made watches and components, this is a direct body blow to their profitability. In fact, they said it already hit their gross margin by 130 basis points this quarter alone. Now, when you're staring down a 39% tariff shockwave, you'd expect a company to be in full-on panic mode. But this is where the market's positive reaction really came into focus. Investors saw that management wasn't just sitting back and taking the hit. They had a proactive, defensive playbook already in motion. Management's foresight here was really impressive. They saw this coming from a mile away. So in the first half of the year, they strategically started building up their inventory of Swiss-made watches right here inside the U.S. They beefed up U.S. inventory by $16 million specifically to get ahead of the tariff. They basically covered a substantial portion of the year's needs before that 39% tax hit. That is just smart planning. And that brilliant inventory move was just one piece of a much bigger strategy. They're tackling this thing from every possible angle. They're rolling out strategic price increases. They're clamping down on operating costs. They're in talks with suppliers, and they're continuing with that smart inventory planning. This multi-pronged defense showed Wall Street that management was absolutely in control. And they didn't just talk about controlling costs. They put a number on it. The company is targeting $10 million in annualized savings from cost-cutting actions they started late last year. This gives them a real, tangible buffer against the margin pressure from the tariffs, and it shows some serious financial discipline. Okay, so let's put all the pieces together. You've got the mixed report, the huge tariff shock, and management's really solid defensive playbook. What does it all mean for the stock going forward? Here's our take. Our view on this lands at what we'd call cautious constructive. We're cautious because, let's be real, this tariff situation is a massive, unpredictable headwind. But we're constructive because that revenue beat, the fortress of a balance sheet, and management's proactive strategy, all of that provides a really powerful counter-narrative to the bad news. Looking ahead to the next quarter, these are the key things we're going to be watching. First and foremost, any positive news on U.S.-Switzerland tariff talks would be a huge boost. We'll also be keeping a close eye on holiday sales numbers, any updates on that $10 million savings plan, and of course, their progress on fixing some of last year's internal control issues. So based on everything, we're slapping a market perform rating on the stock. The company's operational strength and its amazing balance sheet are being directly challenged by some pretty significant macroeconomic uncertainty. Until we get more clarity on how this whole tariff situation plays out, we expect the stock to perform pretty much in line with the broader market. And finally, this whole unique situation leads us to a bit of a wild yet plausible trade idea we're calling the Swiss cheese spread. It's a pair trade. On one side, you go long Movado call options. You're betting on that strong balance sheet and smart management to get them through this storm. If any good tariff news breaks, the stock could pop, and fast. To hedge that bet, you go short a less diversified European luxury watch company, someone who's even more exposed to Swiss manufacturing and U.S. sales. In the end, the answer to our puzzle is simple. Resilience. The market looked right past the ugly headline because it saw a strong company with a smart plan. And as always, please remember this analysis is for informational purposes only. This is not financial advice. Be sure to do your own research before making any investment decisions.